Hi, everyone. Hope you're doing well. Today, I'll just cover Chapter 11. Pretty straightforward. Please feel free to watch this on your own time, and I think it'll help you, especially as we get ready for the second exam. So let me pull up the slides. Okay. So Chapter 11 focuses on sales forecasting and financial analysis. We're going to go through a couple different methods that can be used for this approach. Some of these you might be somewhat familiar with, like regression analysis and ATAR model. We'll talk about some of these in more detail. Some of them, we maybe have not heard of yet. So financial analysis is a real challenge for product developers. You're trying to predict the future. I mean, it's pretty obviously that's a challenging thing to do. But there's other aspects here too. You have a dynamic market, which means that customers and competitors can change over time. So something that might be popular when you're gathering data might not continue to be popular into the future. You're basing forecasts on history, which might not be a great comparison. Technology can change. Nonetheless, some of the approaches, some approach is better than none. Sirius XM radio, when this was first coming out, is originally forecast for 36 million subscribers to start. They revised that to 16 million. That was using the ATAR model is actually what they did. And by the end of 2006, they actually were pretty close to that number. And again, things are going to change. These are, you might be able to forecast how things will be initially, but once a product is actually launched, then you would expect continued growth. So how do we predict the relative success of a new product? You can compare new products to old products, right? So to get a rough estimate, you think, what older product am I replacing? Am I hoping to replace? And they should have the same target population, basic benefit. So if you're using, tires that don't puncture, you can look at common radial tires and see, okay, how quickly did those sell once they were launched? Like I said, we're going to go through a few of these different methods like regression analysis, purchase intentions, ATAR model, etc. So regression analysis, some of you might have done this already in other classes like statistics. You will definitely spend some time on this in marketing analytics once you take that class. But the basic idea here is you gather data using those 5-point scales we've talked a lot about. You gather data on different metrics to try to see, what can predict whether or not someone will use something. So one commonly used model is what you see here this is actually called a technology acceptance model, where you measure the perceived usefulness and perceived ease of use that customers view a new product. And from that, you can then use regression analysis to see how predictive they are to actual usage behavior. And you can see essentially if customers view your product as useful and easy to use, then how many of them will actually go on to purchase a product once it's actually available. Now, again, we don't go through the statistics of this in this class, but in other classes, you will actually see how regression analysis works. Another approach is purchase intentions. Okay, so remember those 5-point scales. Chapter 9, we talked about a scale that goes from definitely do not buy to definitely buy. Well, based on history, okay, and we have this in the book, 80% of people who say that they will definitely buy something actually go on to buy it. And 33% of people who say they'll probably buy something will actually buy it. So this is based on historical data, right? So that's actually great because you can take that 0.8, 80%, and you can take that 0.33, 33%, and multiply it by your survey data to figure out exactly, how much you're going to get. So I've got a little example here using, the example from Chapter 9 of hand sanitizer. And you can sort of see how this works out. Now, not everyone's going to be aware of your product. Not everyone's going to have availability of your product. So you want to try to measure those if possible. And again, as you add more of these metrics, you're just multiplying them by your previous metrics. So you're multiplying, you're multiplying essentially how many people want to actually buy it, by the awareness, by the availability, and you can adjust your predicted sales by that. You could also add growth rate. So growth rate essentially says, all right, how much is this going to grow from one year to the next? Historically, again, we're kind of basing it at, a rough estimate. This is sort of using economics assumptions, but you can project for a lot of products a growth rate of about 10%. There's a lot of variety in that, keep in mind, but 10% is a somewhat reasonable growth rate from year to year. If you look at, stock markets and things like that, 10% is sort of in that correct range. And so you can add that 10%, multiply by the metrics you already have. You could also put these into the ATAR model, which we've talked about, right? Awareness, availability, trial, and then repeat. We haven't talked about repeat, but for a lot of products, like whether it's coffee or cell phones, people repeat purchase. They don't just buy one version. So you can add that metric. And now, again, you're making some minor changes to your calculations. Now, I will say with all of these, one of the things to keep in mind, whether you use the top 2 purchases approach, where you say, all right, the definitely buys and maybe buys, we'll look at them. Or if you use ATAR model or some sort of variation of it, honestly, the biggest thing is just trying to get good numbers. Like, how do we figure out availability? How do we figure out awareness and trial rate? Well, there's a couple sources you can do. And actually, when you get to the 4-person project at the end of class, these sources could be pretty helpful for you. So the textbook, certainly, Crawford and DiBenedetto, we're using the 11th edition in 2014, but certainly, these numbers wouldn't have changed in the last 10 or so years because they're based on decades of historical sales. Public records, whether if it's a publicly traded company, that can be useful. Census data. There's a website that I can show you in class called Statista that's really useful and has really great information that you can use. CNET, TV ratings, Fortune, et cetera, et cetera. So there's a lot of resources out there that can help you or a company estimate some of these metrics. Obviously, the best option would be to go out and survey, 1,000 people. But short of doing that, you can look at the information that's already available and you can sort of make some estimates based on what's out there. Okay, so moving on from the ATAR model, another approach is a diffusion of innovations curve. And again, based on historical data, what this does is it takes a look at how products evolve through their lifespan. So let's say that a product has a lifespan of 5 years. You can essentially split that into these 5 different groups: the innovators in the first year, early adopters onto early and late majority, and then the laggards. And the thing you'll notice is that most products do start pretty slowly. They just reach out to sort of the most innovative consumers first before they eventually get to the early and late majority. Smartphones are a good example of this. Most of you probably would not remember this, but the iPhone, when it came out, the first couple versions of the iPhone didn't actually really take off. I know that seems strange now, but it's true. The first and second versions of the iPhone really kind of lagged a little bit and really only reached sort of early adopters and innovators. But by the time they got to the iPhone 3 and then the iPhone 4, that's when it really took off. And that's when you then saw early and late majority of customers picking up smartphones, making the change from, regular cell phones to smartphones. And you actually still kind of see this now, where if you think of how long people hold on to a smartphone, it might not be 5 years, maybe it's 3 years, but there is sort of this lag where you've got this small group of customers, these innovators who get the newest smartphones right away. On the other end, you have the grandparents of the world who, the laggards who they just want the cheapest option possible. And then most of us are somewhere in the middle, the early or late majority. So whether you're using the ATAR model or regression analysis or top two boxes, there are some issues that you're going to run into. And frankly, some forecasts are better than others. So how do we handle the unreliability of forecasts? There's a few approaches that we can use, like required rate of return and hurdle rates, and I'll quickly talk about what those look like. Required rate of return is where we're saying, all right, we know we're taking on a certain amount of risk, cost, essentially, to make something. What do we have to, what's it going to cost us to get a good return on this? Well, think about a consumer goods company, Procter and Gamble. If they're coming out with incremental products, just the next version of a toothpaste, then the risk is really low. And for them, the required rate of return is pretty low. But if they are going to start coming out with more radical products, then they need to make sure that it has, a higher possibility of really breaking through and making a lot of profit. Another useful tool is the real options analysis. This is where you can view financial estimates side by side. The idea here is that you try to project out for 3 to 4 years, and you try to see, all right, what would it look like if we hit our high-end projections? What if we hit our low-end projections? And what if we just abandon everything and sell everything? So as an example, just a hypothetical, let's say for a product on the high end after 4 years, you're looking at a profit of 136,000, on the low end 34,000. And then what if we just abandon it? Then it'd be 48,000. So in this case, the idea here is you're looking at the low end and the abandon option, seeing if there's much difference here. In this case, there's actually not a lot of difference. Technically, the low end, if you really bomb, does worse than the abandon option, but like not much worse, right? Going from 48,000 to 34,000, there's still like a small profit. But you do have a high end here that's, multiples higher than the low end. So in this case, you would say, you know what, there's not a lot of risk in just pushing through, but there's a payoff after a few years if we're able to move forward with this project. So in short, you're trying to see this low end projection and compare that to the abandon option. And seeing if there's a big difference, then maybe you drop a product. But if there's not much of a difference and you have a high end projection that's much higher, then you probably want to stick with the project. Finally, the tool that can also help with this is what's called a hurdle rate. This is actually a little bit of like similar to a culling factor, but it's sort of I would say it's almost more of a positive, like, saying this is what we're trying to do to go forward. So it's a minimum rate of return on a project a manager or company is willing to accept. And so this is going to vary from product to product. Some products you want a high number of sales. Some products you want high market share. Every product accomplishes a different goal. So with that in mind, you want to have a different hurdle rate. So for example, in this here, product A, the market share doesn't increase, but the potential for higher sales is there. So, okay, so your hurdle rate is going to be based on sales. For product B, the sales is high because you're trying to get into a new market, but you're hoping to get more market share. So the market share ends up being the hurdle rate. So you're picking one of these metrics to say, this is what we need to achieve in order to say that it's worthwhile to go forward with this product. So giving, some financial aspects to the new product development side. Okay, so that's all I have. So everyone, please, let me know if you have any questions. Otherwise, I will talk to you soon. Thanks.